Good morning and welcome to the Bloomberg Daybreak Asia podcast. I'm Doug Krisner. Here are the stories we're following today. Joining us now is Mary Nicola. She is Bloomberg M-LIV strategist, joining us from Singapore. It's always a pleasure to speak with you. I know that you write a lot for the blog, and I'm curious as to what's top of mind for you today. What are you kind of trying to feature here? What is the market wrestling with, and what are you discovering as you take a closer look?
Yeah, there's a few headwinds, really, that's shaping how we're looking at markets. So obviously there's the repricing of the Fed because we've seen an improvement in the U.S. data. But then there's also this other confluence of factors, including the U.S. elections, where there's people are on pause here in Asia trying to figure out how does this affect Asian markets? What are the implications of, let's say, a higher fiscal deficit or the implications of potential tariffs. And then, of course, you still have the fundamental backdrop. So you still have to focus on the labor market report, which is coming next week. You have a busy earnings season. So there's a whole number of things stacking up that's not giving, Asian markets a chance to really breathe. And then, of course, you still have China that's hanging in the wings, where we're still waiting for the NPC Standing Committee and some of their decisions and how that will affect the next phase of the implementation of the stimulus that they had originally planned.
So what are people saying about the stimulus that we are aware of so far, the programs that have been announced? And I know in many cases the actual program itself has not been implemented. We're waiting for that. But do people really, the people that you speak with, do they believe that this is going to have a fundamental shift in psychology, where the investment community, where the retail community is concerned, consumers are concerned? Is it going to move the needle at all?
Yeah, it really comes down to what they're going to do on the property market, right? Especially on the retail side. Remember how involved the retail sector in China is in their own equity markets. So, and they've lost a lot of money on their property. So if they haven't seen that recovery come through, or if they haven't seen anything come through on the property market, that's still going to weigh on sentiment. And then, of course, for foreign investors, you're still thinking about, okay, how are they managing the property sector? How are they going to boost consumer demand? And then on top of that, it's what's going to happen between U.S.-China relations. So, and then, of course, you have this report that came out this morning about China's stimulus being insufficient from the IMF in terms of improving and curbing, deflationary risks. And and they're saying that what they've set out is not enough.
It's interesting. I can't tell you the number of conversations that I've had on this topic where the question that comes into my mind is, can China basically fall into the same trap that Japan fell into for 3 decades? And that's a real debate. Some people say, no way, China's a very different economy. But many people say, yes, the analog is sufficient, and China is running the risk of remaining in deflation for a substantial period of time.
Yeah, the similarities are really hard to ignore at the end of the day between what Japan experienced in the 80s and 90s versus what we're seeing with Japan today. And a lot of it has to do with, we can't forget, they had high debt, deflation, and then, of course, depressed consumer confidence. That's what Japan had during their time. That's what we're seeing now with China. So it's hard not to draw the similarities unless you see really aggressive stimulus coming through from China, which really we haven't seen yet, to allay some of these concerns and to ignore the potential Japanification of China.
Let's stay with Japan for a moment, because this yen has been dramatically weakened in the last several days. I think earlier today we traded on the weak side of 152 against the dollar. I know we have a BOJ meeting around the corner. I haven't heard of anyone that's expecting a move from the Bank of Japan. So we are looking for a period of time when you got weakness in the yen and maybe intervention on the part of the Ministry of Finance. Is that what we're looking at?
Yeah, for now, we're seeing a lot of verbal intervention coming through, right? Just a little bit of jawboning to talk down, to ensure that the yen doesn't go too weak, but it can only help for such a period of time, right? It has its limits. I think what the main thing is for Japan, obviously one of the biggest factors that's really impacted the yen has been the repricing of the Fed. That's been first and foremost. Yeah. The second impact has been coming from the concerns about politics. If LDP doesn't have a clear mandate, then you just leave a vacuum in terms of what the BOJ is going to do, in terms of how are they going to move ahead with policy if there's increased political volatility. And I think that's also weighing on sentiment of the yen. Of course, you're seeing just higher volatility with the yen.
But there's also an inflation story that's been happening in China, and this is something that the BOJ has been waiting for years to occur. It's happened. It's been happening now for 2 years, it seems like, where inflation has been above that 2% target. What do we know about the inflation story in Japan right now, particularly if you look at a currency that's going to continue to allow for the importation of inflation into the Japanese economy?
Yeah, actually, it's really interesting. If you chart, let's say, Japan CPI versus the yen, it's this perfect relationship, obviously indicating that the much of what has been driving inflation has been the yen weakness. And then you've had some of the numbers coming out today for October CPI for the Tokyo CPI numbers. They were still above 2%. But they are creeping up in terms of being a little bit higher than expectations. So and people are feeling the pain on the ground. So if they don't do something, you could see inflation really getting out of control. And that puts a real conundrum for the BOJ, because if you, let's say, have potential political instability or a weak government versus higher inflation, how do you manage that balance?
So no change in BOJ policy next week? But
not this week, no.
Okay, so is it fair to say that we do get maybe some action either in December or January? Is that what the market is telling us?
Market's telling us a little bit later.
Oh, really?
They're still not believing that they're looking for any sort of changes from the BOJ. So if we look at, let's say, what the market is pricing, they're not looking for really any moves. Let's say, another 15 basis point move until January. Let's say if we're looking for a 15 basis point move,
okay,
until January. So there's still some time where the market is, and even BOJ Ueda said, time's on our side only recently. So there's still something, but I think in terms of what if the pressure from the currency and the currency weakness becomes too much, they may be forced to act sooner rather than later.
Yeah, it's been remarkable to see how quickly the yen got here to around 152 against the dollar. Mary, thank you so much for being with us. It's always a pleasure. You. Bloomberg's Mary Nicola, M-LIV strategist, joining us from Singapore here on the Daybreak Asia podcast. Joining us now is Gene Goldman. He is the Chief Investment Officer at Cetera Financial Group, joining us from Los Angeles. Gene, thanks for making time to chat. Let's begin with the Fed, because lately the market has been kind of debating the degree to which the Fed is going to potentially scale back its pace of rate cuts. Where are you in this debate right now?
When the Fed came out with 50 basis points in September, I was shocked. I mean, I didn't think they should do that. Think about this. The employment picture was not as bad as the Fed had believed. Yes, the unemployment rate had picked up a bit, but that was due to labor force participation. Jobless claims are still pretty low. Payroll report looks pretty good. The entire economy is not that bad. Retail sales, the economic surprise index, GDP, I can rattle off tons and tons of data that says the economy is better than expected. And what worries me is that the Fed is stimulating an economy that does not need to be stimulated. And what happened to the Fed's focus on data dependency, right? Where did that go? So I do think the Fed will need to lower rates still, because we're still pretty restrictive at 2.25 over inflation, but they've got to slow it down. I suspect maybe a quarter in November and a quarter in December, but that 50 in September was ridiculous.
So if the market has to recalibrate the idea that the Fed is going to be accommodative, I mean, to say that maybe it was, as you said, overly aggressive in estimating rate cuts, is that a risk for the equity space?
It is definitely a risk. And the bond market is screaming it's a risk. Look at the 10-year Treasury yield, for example. Right before the Fed cut rates, it was at 362. Today, I'm looking at my Bloomberg, it's at 419. That's a big surge in about a month. That is a scary surge in just 10-year yields. And you saw what happened. Mortgage rates, as we all know, are tied to the 10-year Treasury yield. Mortgage rates moved higher, closer to 7%, slowed down mortgage applications. You add this with rising geopolitical risks, election uncertainty, third quarter earnings are okay. And then you add on a little bit of, you'll sprinkle in a little valuations and concentration. We have ourselves a setup for a big volatile period coming up.
So what industry groups are most vulnerable right now in your estimation?
Clearly the high valuation and the high concentration industry groups. So clearly technology, communication services, the big ones, consumer discretionary. I think those areas are ripe for a pullback. I think the areas, on the other hand, that look pretty attractive, really defensive growth areas like healthcare. Healthcare is one of our favorite sectors. I think it's defensive growth, does well under a divided government, and neither Harris nor Trump are proposing any major healthcare reform. Also, value sectors, small cap looks pretty good. We see whenever the Fed cuts rates, market breadth tends to widen, and you see, for example, equal weight S&P is outperforming market cap S&P over the last few months. Great news. So we would look at value, small cap, defensive growth, and a great area I think is pretty attractive is financials. Yield curve steepening looks pretty good for financials. Banks are going to make more money in this type of environment.
Are you seeing opportunities offshore right now? Europe seems to have the inflation story under control. Maybe some rate cuts are in store, and that may be a way of revitalizing growth on the continent. And we've been talking a lot about the stimulus programs being unleashed by Beijing and perhaps a growth spurt that may occur in China. I'm curious as to whether or not you're exposed offshore right now and to what extent.
Yeah, so we're neutral in both areas, both emerging markets and international relative to our benchmarks. Both areas are pretty good from a diversification standpoint. You do want some exposure. We're not ready yet to jump full both feet in yet, just because we want to see a weaker dollar. A weaker dollar will benefit both investing in both areas. We don't see the weaker dollar yet. The dollar has weakened a little bit, but we want to see more oomph in that weakness of the dollar. And to get that, once we get that, that will help us drive our investment outside the U.S. I think China, has a pretty good surge in the markets, really on monetary policy, but we need to see more on fiscal policy. And you think about China has this big overhang. The lingering one-child policy has really hampered their consumer spending. And China is trying to transform, as we know, from a manufacturing to a consumer. They're trying monetary stimulus, but fiscal stimulus is not there yet. So we're not ready yet to jump in emerging markets really full aboard yet.
We're getting very close to the U.S. presidential election. How do you feel about this as a factor in determining the direction of the market going forward?
That's a great question. First of all, the old story. Listen, during an election year, if you look at the last 20 election years, the stock market has been positive in 18 of the last 20 years. We don't see that being a difference. We do think that the stock market tends to ignore the election. But with that said, though, historically, what you've seen is that usually the first 2 months going into an election, there's a lot of volatility. Stocks on average fall by about 60 basis points. But the key period from election day to inauguration, on average, the stock market returns about 1.5%. So we do see some solace in the fact that whoever wins the election is that at least we find out who wins the election. That's actually pretty good news. And you're seeing a lot of companies out there who have come out and said, you know what, we are going to delay projects, we're going to delay hiring, we're going to delay whatever it is because we are unsure of who's going to win. But the good news is that whoever wins, we're likely going to see a divided government. So really, at the end of the day, I hate to say this, but nothing gets done. Markets are going to like that. So I think near-term volatility, but at the end of the day, just like we've been saying, with the recent pullbacks, any pullback will be a buying opportunity because again, nothing will get done and lots of cash on the sideline waiting to get in at a better valuation.
Boy, I'm glad you mentioned that point because I was reading an article on Bloomberg today. A stampede of cash has been flowing into U.S. money market funds. In the last week, I think something a little over $40 billion moving into money market funds. What will it take for that money to come off the sidelines and be put to work in either the equity market or in the bond market?
Yeah, so we look at there's 6 trillion of money market assets on the sideline, but we also look at money market assets and cash and savings in bank accounts because we do think there's some high correlation there, and that's $24 trillion. What we think will happen if we have a pullback, if we have better valuations, just like we saw in the almost correction in July, just like we saw in the correction in October of last year, that money is waiting to come in for a better valuation. We do expect some of that money will move in as prices come back in line to long-term expectations. Right now we have high valuations. The PE ratio in the S&P is 22 times forward earnings, high expectations, high concentration. All this is kind of a mix for volatility, and markets money is waiting on the sideline to move in slowly. On the fixed income side, I think the good news is that if you look at bond fund inflows this year, there's only been 1 week that's been an outflow. So there's still a lot of demand for bonds. I just think right now there's a lot of people waiting on the sideline, worried about duration risk. So what we're telling our clients today, good news, bonds offer an attractive yield relative to inflation, over inflation. But at the same time, though, we do think yields will come down eventually, especially as the Fed starts to, cut rates. I think you look at next year, 2 years, the ending rate for the Fed is at 2.9 to 3%, maybe a little bit higher, but regardless, long-term rates are coming down, but we'll see what happens.
Yeah, there's still a debate over where the terminal rate is. Do you have a sense of that?
If you look at let's say the Fed, let's believe the Fed says 2.9 to 3. I do think it's going to be a little bit higher than that because let's just say that we have more government spending. Let's say that, you look at, for example, the government. He just ended his fiscal year. We're at what $1.8 trillion, third highest deficit on record, over 2020 and 2021, third highest year. 950 of that $billion of that was for treasury payments. We do see a lot of treasury payments coming in. We do see a lot of debt, a lot of yield coming into the market. But again, there comes a point when you're thinking at yield over inflation. So there's some pretty attractive areas. So what we've been telling our clients is it's okay to be, strong in durational, interest rate sensitivity, but there comes a point you need to ratchet that down a little bit, especially if the yield curve steepens and there's some attractive opportunities on the shorter end of the yield curve.
Gene, we'll leave it there. Thanks so much for taking time to be on the Daybreak Asia podcast. Gene Goldman, Chief Investment Officer at Cetera Financial Group, joining us from Los Angeles. This is Bloomberg Daybreak Asia, your morning brief on the stories making news from Hong Kong to Singapore and Wall Street. Look for us on your podcast feed every day on Apple, Spotify, and anywhere else you get your podcast. Our flagship New York station is also available on your Amazon Alexa devices. Just say, Alexa, play Bloomberg 1130. Plus, listen coast to coast on the Bloomberg Business app, Sirius XM, the iHeartRadio app, and on Bloomberg.com. I'm Doug Krisner. Join us again tomorrow for all the news you need to start your day right here on Bloomberg Daybreak Asia.